Hey guys, welcome back, and in today's video I'm going to talk about fair value gaps and inverted fair value gaps. Basically how I use it, how I interpret them, and how you can do exactly the same in order to profit from the market. We'll go through exactly how they look like, where to find them, and how and we'll go through some examples. We'll even go through live examples. So if you're serious of taking your trading to next level type of thing, but also want to become profitable this year, why don't you grab a pen and paper, and I'll see you right after the short break. Okay, so what is a fair value gap? A fair value gap is 3 consecutive closed candles after another. So let's look at this example. We've got 1, 2, 3 candles. Your focus point goes to the first candles, the low of that wick, and see where does that fill in the second candle. Then you look at the third candle's wick high and see where does that fill in the middle candle. What's important to note here is that if you mark out the first candle's wick low, I can draw it perfectly, and you look at the third candle's high. So now that center, that piece here, where the first candle's wick did not overlap with the third candle's wick, that is the fair value gap. That is the gap that is important for us to use. And the same thing applies if you look at upwards move. So you would mark the same thing out. And in a situation where the wicks overlap or there's no gap, then obviously that is not a fair value gap. But these are the two prime examples from a downward move and upward move. You just follow the candles, and we're gonna look at it now in more detail when we look at some examples and some charts, so you can get a proper feel and see how our price actually behaves around those fair value gaps. All right, so what is then an inverted fair value gap? Basically, an inverted fair value gap is gonna look like this. If you, let's just copy this one. If you get another candle, I know it's not looking the best right now. Let's just let's do it like this. Okay, so now you've got your fair value gap that formed, and then suddenly you get the fourth candle or any other candle, and it bounce right back and close above that fair value gap's high. And the same applies for a down, upward, for reversal to the downside. You'll see some sort of reaction for a candle to close below the fair value gap's low. That is normally and that's basically called the inverted fair value gap, because this fair value gap you invert it by closing over it. And I'm going to show you guys how to identify those as well, and how you can use it to your advantage, benefit, how to profit from, and just to understand what is the core meaning of a fair value gap. So basically the way I use fair value gaps is I can use them as support levels, I can use them as resistance levels, I can use them as continuation, I can use them as reversal patterns. And if you know what to look for in a chart and this presents itself, if you're at a specific level where you think price should actually reverse from here because there's some liquidity that's just been taken and I'm still bearish, so I'm looking for some sort of sign that tells me we're turning around now to go back into the direction that you favor, or the bias that you have. And that is what's going to make you successful using these patterns. All right, so let's move on and look at some examples. All right, so in here I've done a screenshot of some examples. You might say yes, it's picked. It's been picked because I need to show it to you, right? And then obviously we're going to jump into a live chart after this that happened on Friday, so I can take you through that and see if you can also see what I saw. All right, so in example 1 you can see a nice up candle there, and between the small white candle, the big body white candle, and the black candle, that is your fair value gap, because the first and the third candle did not overlap within that body, and we can see that's your fair value gap. Then at some point you see a black candle close but did not close below it, and that's not your inverted fair value gap yet, right? So what you were looking for is for the next candle, and in this candle you can see it moved up into that dotted line and then closed below it. That's your signal to say, guys, I'm actually thinking of shorting this, or take the short. You'll put your stop above the fair value gap, and then you will look for the recent liquidity low and try to target to go to those lows. Why is that dotted line so important? So basically, if you take a fair value gap and you divide it in two, that 50% level is critical for you to understand that you are on site. It's all the little clues that a chart will leave behind. So first of all, if you see a candle, in this case we've got a fair value gap that was suggesting price to go higher. If you see a candle close below that 50%, that's already giving you a clue that there's a lot of sellers in this fair value gap, and they might continue to the downside. Then you wait for another one, because we haven't closed below that fair value gap yet, right, to turn it into an inverted fair value gap. So therefore we're still within it. Price can easily turn around and continue higher. Then the next candle came down and spiked into that 50%, did not close above it, and then rejected there to close below the fair value gap. Turn it into a valid inverted fair value gap. You can then take the short, put your stop above the fair value gap, and then target recent liquidity lows or a swing point. All right, then we see price goes down, consolidate, create another fair value gap, 3 black candles. As you can see, I did not mark it out here, and the reason I haven't, I'm going to take you through the reasons a bit later. But if you look at price come back in there and it's holding price, but then price goes above it and then drop. That is not a A+ type of setup, and you can't blindly after this video go and trade every fair value gap and inverted fair value gap you see. You got to have good context behind your trade in order to know what you're taking and when you're taking it and why you're taking it. For now, I did not mark that out because that's not a good example, and if you see the rules later in the live chart, then you'll understand more. But for now, leave it at that. All right, so we're still consolidating. Remember, this 850 low, that's the target. And then we see in example 2, we see this black candle drop down, taking those lows out. Now you're expecting some sort of fair value gap to form. It did, because the black candle before the big black candle's wick did not overlap with the white candle's wick, so there's a little gap in there. And see how this fourth black candle spiked into that 50% right to the top of it and then reject. That tells me we're not ready to invert this fair value gap yet. So then my eyes goes to the recent swing low, which is this one here, and then price aggressively pushed through it. That's liquidity grabs, and then suddenly we see this massive push up to invert this fair value gap. And that's the reversal you're looking for, and you can see how it behaves. It takes price all the way to the top. But now that you've seen this reversal, you can expect price to go higher. What do you do then? You start marking out the fair value gaps. In example 3, that big white candle, if you go to the bottom, that black candle, so wick did not overlap with this second white candle's wick, so that's a fair value gap. If you extend that out, you'll see this white candle pinned into it as using that as support and push price higher. So you've got a fair value gap here, price went up, create another fair value gap. The possibility for this to get inverted is great because you're coming from a liquidity grab that got inverted. It gives you another opportunity. It closed. Remember what I said earlier, we close above that dotted line, so now you already got some sort of indication. Listen, I think we are going to go higher because of the context down here and a little clue left over there in that fair value gap. The next white candle closed above it. You could have entered there. You would probably say, listen, Neil, I've put my stop below that and I got stopped out. So with a fair value gap or inverted fair value gap, if a candle closed, if this black candle closed below this inverted fair value gap, that for me would have been, I closed my trade. I normally give it some room to do what it needs to do, because a candle can spike out of it to obviously confuse a punter or trader that like to preempt certain moves and then just stop people out and all of that. So if you do this more, you'll grasp, you'll get more affair with it, you'll get more experience around it and know how to actually use it properly. But that's what I would do, because we've got context, like I said. We're expecting some sort of a rejection here. We get the rejection. You can still enter there. We get another test and rejection. So it gives you ample opportunities to enter here. And then you see price goes higher. Then look at this white candle here. This black candle's wick up there, and this white candle's wick almost in line there. So it leaves a tiny gap, but that's not a fair value gap that you want to hunt here. Then you get a proper fair value gap here. What does price do? It comes and tests that 50%, consolidate, come and test it again. That's nice support. Alright, so here's another example of support, just to show you guys what happened after the support. It sent price higher. Alright, so remember I also said you can use fair value gaps and invert it as reversals. We saw what the inverted fair value gap did, and fair value gaps using it as support and resistance, depends on the direction, and also as liquidity. So in this example, you look at this fair value gap over here. It came up. These candles did not push up, or even this big black candle did not go and test that 50% at all. So these are liquidity highs sitting here waiting for some price in the future to come and run it to then continue lower. And all you had to do is just wait for the market to turn. In this case, we see this big white candle leaves a little fair value gap here. We can see these two candles spike into it, use it as support, and then gradually start moving up. And what I want to tell you, this is a 1 hour chart. The previous chart that we looked was a 1 minute chart, so it works on all time frames. All right, and in this case you would say, all right, so where do we go from here? And the fair value gap, those highs, that is your target, and price made its way there. And I'll show you what happened on a 30-minute chart. This is a 30-minute chart, and that's exactly the same chart we just looked at it. We just break it down a little bit, and these were relatively equal highs, forming liquidity there. And look at this. So price is going up slowly and then aggressively pumped up, run it, leaves a fair value gap there. What did this candle do? Reject and close below there. This candle wicked into that fair value gap, to show you we on site, and this was an A+ setup to take a short there and then target these lows, and as you can see, price just dropped heavily from there. Alright, so what I'm going to do now is, now that you guys got some sort of a good understanding of what fair value gaps and how you can use it, I'm going to jump into a live chart from Friday, and I'm going to ask you guys to have a look and tell me what do you see. And you can obviously pause the video and mark some stuff out, because I'm going to show you all my annotations just now, and then we're going to just go through it in a little bit more detail to give you more of a context of some good trades and all of that. Alright, okay, so let's put on my annotations because I know you guys did not pause the videos, so let's move on. Alright, so we're only going to focus on the blue boxes. Alright, so we can start by looking at a nice liquidity low here, aggressive push down, and let's just look at the blue boxes first. Alright, so then this candle wick is down here, this white candle moved up, and this white candle spiked down, fill that potential gap. So never left the gap down there, but then form a gap here between those three white candles. Yeah, those two white candles, the third one is the fair value gap. Then you see price run away, never came and tested, and then eventually come and test it. Why was this a good buy? What does this 50% means? So what you can do, or think about it this way: if you were a business owner, right, and you had to go out in the market and buy, I don't know, cell phones, and you need to go sell it, are you going to go and buy it at the most expensive price and try to sell it, or are you going to look for a good discounted price to go and sell it? And vice versa. Obviously, if you want to buy the stock with the supplier sell it to you at the highest price, and you will pay for the worst price, or are you going to try to get it at a cheaper price? I don't know if that all made sense now, but what I'm doing is I'm looking at this swing point here and that swing point there, and I look for where, if I measure them, that range, where's the 50% line? That 50% line is right here, right? And that 50% line lines up with this fair value gap. So that gives me context to say, right, so we run liquidity on the left, we pushed away, we come back into a discount. Anything below 50% is discount because you want to buy. Anything above the 50% is premium. So you don't want to buy up here, because then you just pay, and then you can have a huge drawdown if price wants to come down into a discounted price. So it's always good to wait for price to go into a discount. And in this case, it came into discount. See how it's holding that fair value gaps dotted line at 50%. It's below the 50%, so you could have entered down here and obviously set your stop and target some highs. All right, so then we get another move up, and boom, we go back into this fair value gap 50%. Now you guys going to say, all right, Neil, so you worked from this low because that's the swing point. Swing point is 3 candles. The middle candle's low is lower than candle 1 and candle 3. That's a swing point. That's another swing point into the fair value gap. If you measure that, 50% is down here. How did you see that as a good buy? We are going to come back to this one so I can explain it. But let's just go through so I can show you guys, once you've spotted a reversal, how can you use fair value gaps as support levels in the right context to make some money. Alright, so that was a good buy, and I'm going to explain it. Then we see this swing point down here, and this white candle leaves another fair value gap. Retrace into the fair value gaps dotted line, but spike below that. Just below that is a 50% of this swing to that swing. So there's your discount. That's where you buy. Immediate reaction, pushing price higher. And here we can see another fair value gap, but this time when you mark this low and that high, you're not getting this fair value gap doesn't even sit within it's in premium. So that's not a good place to go and buy. But what does price do? Price consolidated above that fair value gap, creating equal highs, which is liquidity, and then suddenly push price up and then aggressively rejects. What happened when price rejected? Alright, so now this fair value gap has basically turned into a inverted fair value gap. We call that a IFVG, inverted fair value gap. Alright, so now we know there was equal highs, we run it, we pump down. Now we're looking for price to come down. Alright, now the context is all these lower, higher lows, higher lows, higher lows, higher lows. That's all liquidity. People put their stops there every time price goes higher. They put their stops there. Stops, stops, stops. So this aggressive move is obviously intent to go down and take all those stops out. Alright, so let's start from the beginning here. But this time we look at the orange boxes. Okay, so that orange box there, after we've run this low, we inverted that. Why did price not go here? Because this fair value gap formed right on top of it, and it's all below this 50%. Price could have easily spiked through this fair value gap into this inverted fair value gap as a support level in order to go high. Alright, so now why did I say even though this fair value gap or this low never came to 50%, why was this a good buy? Now, if you look at this black candle here, it created a little fair value gap there. That got immediately and aggressively inverted. And then you can see the inverted fair value gaps 50%, and that fair value gap, the big blue box 50%, lined up. That is a solid line of defense to prevent price from going lower. So that's why that's a good place to buy. And as you can see, we spike right into it. Look at this middle candle's low. That low is perfectly filling that IFVG's low. Alright, so then we see price goes higher from that, and that's why we would have taken that. Now we got it inverted on this side, and obviously just to take a step back, that's a reversal pattern. That's a reversal pattern to this little pullback, and that's continuation support, continuation support, continuation, and now we turn the tables to the other side. Now we've got this. Now you would say, alright, so why would you sell here? Because it's simple. If you take this high to this low and you look at this 50%, see how price and the fair value gap's middle dotted line is just above that. That's giving you 1, 2, 3, 4 entry points to sell the stock or this market. Same thing happens here. You would say that's not 50%. Well, let me show you. If you take this high to this low, it's literally spiking into those 50% level. So that is still, even though fair value gap's up here, so what you would have done is you would have entered here, or maybe put a entry up here. You might have even missed it, and if you have, then it's not the end of the world. But that just shows you how something can start turning into resistance, and on this side where it obviously hold price as support and continuation. And I mean, we can carry on with this. I mean, here's a chart that I haven't marked out, but I can show it to you. Let's go through it. And again, you can pause this and see if you guys can see what we've learned. And there's no annotations. I'm going to switch on. I'm actually going to draw it out as we go through this. All right. So first of all, this was PMI, right? PMI was on Friday, and this candle here was the PMI candle, but we've got very close equal lows on this side, so I would most probably say let's use this as equal lows, liquidity, and let's just mark it out. So that's where we expect price to be. Remember, we haven't shorted anything yet, but there's a target down there. There was liquidity up here, we spiked through it. We didn't invert anything as soon as we broke through these equal highs. The PMI candle spiked through it and closed below it. So if you're a retail trader, you might have looked at this and say, geez, we're really rejecting this level, so let's sell here. Then you would have been, gotten wrecked on that. And and that's why it's so important to look for fair value gaps that gets inverted. So now you know, all right, we've run this. There's no fair value gaps here. There's one down here, but that's not helping me to go here. But if you traded the news earlier, you could have taken this support or this stab into this fair value gap, into this equal highs. But I'm not telling you guys to trade PMI or read for the news. That's something I've been doing for a long time. And let's just have a look what happens here. So now these candles are keep making higher highs, and we just keep following these highs. There's a fair value gap. I never take the first fair value gap that gets inverted after the news, because that could sometimes just be a false signal to go higher. That's also important to obviously know what you're looking for. But then we price push higher again, and the minute this happened, we created the inverted fair value gap here. And let's go through that. We push up, run that high, use the fair value gap as a support level, and then broke through it, and aggressively push lower. Then we see price go back into that IFEG where you would have entered, and now it turns that IFEG into a resistant, a place of resistance, right? And now we know we've got this nice target down here, so you can enter in here. And again, to show you guys, 50% is where that IFEG formed. That is what is important here. Now you know anything above 50%, that's where I'm selling. Alright, any other traders who use Fibonacci 69, that will be in your entry, but we are trading inverted fair value gaps. Alright, and then suddenly we get this breakdown. There's a fair value gap, so there is liquidity down here. So that's the other thing, we use IFEGs or fair value gaps as liquidity, and that is something that did not play out on Friday, because maybe it was Friday, maybe they're leaving it for some other day. But anyways, if price had come back into this fair value gap, that would have been a nice place to take a short, and then to try to target these lows. But anyway, so price eventually went down there, spiked into it. You would have been out of the trade, you would have made your money, and you would have moved on. This example is just for me to show you guys there's fair value gaps all over the place. You need to be very specific as to when you take it, where you take it, how you take it. The best thing you can do is mark out liquidity, wait for a candle or a fair value gap to run that liquidity, then wait for that fair value gap to get inverted within less than 5 candles, and then look for your, in this case that was 1, 2, 3, 4 invert, and then look for it. But we had some good context here as to where we expect price to go and why, and that's what I've got for you guys, and I really hope you guys find any value at looking at what fair value gaps can do for you and mean for you, and how to use them as as we've gone through. And there you have it, guys. It's as simple as that. Trading should never be complicated to start with. So if you find any value through this video, please give me a thumbs up, subscribe, and leave some comments below. And don't forget to set the notification bell so you can get notified when I put content out like this. And also, guys, remember, I trade these setups live every day on my YouTube channel, so don't miss out. Go out to my channel, check it out, and come hang with me and see how we trade this live. See you in my next live session. Bye bye.